I'm really going to talk about earnings quality and like how it ties into valuation of company. The topic really, like Ryan says, it comes up because we commonly highlight things when we don't like when they're in earnings, especially adjusted earnings or other metrics that companies report. So first off, if you're not aware, earnings quality, if you look online, there's slightly different wording and definitions. I'll really define it here as earnings quality is how reliable earnings are for the current and future quarters, as well as how persistent their earnings are going forward. Simply how well the financials represent the company in its current and prospectively in its future state. The need for analyzing earning quality is really due to our accrual accounting system versus just pure cash flows. Accrual accounting attempts to reconcile these cash flows with the actual operations of the business, but because cash flows are really just lumpy. A basic example of this, a very basic example, I should say, is if you purchased $80 of inventory in Q1 but did not sell it, under a cash system, you'd be down $80. Where under accrual accounting systems, you don't account for it until the inventory is sold, as you match the cost with revenue when it occurs. So in the next quarter, Q2, if you sold the revenue for $100, you'd recognize $100 in revenue, and then you'd recognize the $80 cost then, as well as the $20 in gross profit. Really, accrual accounting is just trying to smooth out the revenues and costs to match the reality of the company's operations. Its cash flows, they're just lumpy and don't always represent the company's operations within that time period. Because let's say another example, if you got an upfront payment that's like 90% of the company's revenue for the year, but it's all in one quarter, you'd be realizing that all right away, which obviously that's not realistic. But unfortunately, accruals just require estimates and judgments, so they can be inaccurate or even potentially be manipulated. So the issue is as well, management actually has incentives to make earnings look good, as well as they can. So you have a system that is able to be manipulated, and the party who controls much of the process being incentivized to manipulating earnings. So obviously there's been many issues with that in the past. Two of the largest examples of extremely low earning qualities ending in bankruptcy are Enron and WorldCom. Part of Enron's fraud was using mark-to-market accounting, which is normally reserved for financial institutions, and they use it to inflate their earnings by having future estimated cash flow. So there's an estimate represented in current earnings as a present cash flow, vastly increasing earnings with little relying on with little evidence of like the future earnings and cash flows coming through, and it's all just in the future, not at the present, but they were saying it's in the present. Whereas WorldCom, they capitalized expenses, which effectively means they realize over time, propping up current earnings. So there's two different cases, very well known. You can look into them in depth more if you want to, but neither WorldCom or Enron had cash flows. So they'd be low earnings quality just because of that standard. When you have that big gap between reported earnings and cash flows, that can be a really strong sign that you're having earnings manipulation. But more commonly, and probably more important to us, is earnings manipulation is not completely fraudulent companies. The term earnings management is when a manager manages the company's accrual to really fit its needs or the manager's needs. As I mentioned before, accrual accounting really requires estimates. Some of those items have high management discretion, so the management really gets to choose what they're going to do with it. A couple of examples of this is accounts receivable for the portion of the accounts which the customer who paid for the goods or should pay for the good, they don't pay. So you might have an accounts receivable write down in the future, and they have to estimate effectively how much that is going to be written down and how much they're actually going to receive. Inventory, how much should be written down or kept at the current value. Property, plant, and equipment, where the management needs to estimate the life of the asset, which impacts the depreciation, which impacts the depreciation expense, which if they have a long life when it should be a short life, that would increase earnings. And of course, many more. All these actions are within GAAP principles, but are highly dependent on managerial decisions, which allows the manager to manage or massage earnings to fit what they need for the quarter or set up earnings for the future quarters. Managing earnings could be self-interest, such as just hitting a bonus target, profit from insider trading, or for the company's sake to issue shares at a higher price. That is not to say these estimates can't be just changed in good faith, but it's not always clear if they are in good faith. For example, current one in their most recent 10K, so at the start of the year, Alphabet, the parent company of Google, just increased the estimated life of its servers from 4 to 6 years. Now the related equipment from 5 to 6 years, meaning depreciation expenses lowered about $988 million, and after the tax adjustments, net income by increasing by $770 million, or about 6 cents in the last quarter, increasing their last quarter's EPS by about 5%. Even though nothing really changed for the company, they literally just changed their estimate. That's all they changed. 5% increase. That's better growth than some companies do just by changing an estimate. So is it in good faith? Were the initial estimates just wrong and they need to update them? Or were they doing the proper thing? You can't really tell in this situation. Further, let's shift out of GAAP earnings, which are rule-based, but you can kind of shift around them, to non-GAAP metrics, which are becoming more and more common. Non-GAAP earnings really allow for management discretion just to do what they want. They include and exclude what they want to report. Common metrics like EBITDA, adjusted earnings, free cash flow, and many, many more. They are commonly reported these days, and especially in press releases. S&P 500 companies who report at least one GAAP metric increased from 59% in 1996 to 94% in 2020, as well as they now report from an average of 2.5 in 1996 metrics to now 7.5. So they're reporting their adjusted EBITDA, their adjusted earnings, and so on, instead of just a couple of them. The pro of non-GAAP earnings is they can potentially better represent the company's operations, such as removing one-off impacts like acquisition costs, but also they do decrease comparability between companies because it's not standardized, as well as they increase management discretion, resulting in easy earnings management or massaging, whatever you want to call it. So let's take an example, and I've been using my punching bag lately, NVIDIA, since it was in the spotlight last quarter. Their GAAP EPS was 82 cents versus non-GAAP of 109. The uplift was just primarily due to stock compensation, which contributed about 21 cents of the 27 cents of the uplift. Whereas other companies, they don't issue much stock compensation, or they don't add it back to their adjusted earnings. So that reduces comparable earnings. So if you're comparing NVIDIA with another stock, they're going to look more comparable just because they added it back if you're just using their headline earnings, which you'll constantly see referenced online, even analysts will just straight up use them. And really, let's look at what NVIDIA could have done and it would have been included in their earnings even under this. So they issue shares. They could have issued shares or stock options or warrants in the public market or to a private investor, replicating their stock compensation and paying the employee, which initially was stock compensation, in cash instead. Same dilution, same outlook, but it would be lower GAAP earnings under non-GAAP earnings under them doing that method. But it has the same overall impact. So which one are you going to choose? The point is just, it's purely non-standardized managerial decision, and it's just raising headline earnings, which many people end up using in their valuations, making them more appealing investments. And that's really why we constantly bring up stock compensation as well as other things, even acquisitions we've brought up before. One is a company which is a serial acquirer. They're discluding these acquisition costs, yet they're there every single quarter. Is that really representing their operations when it's these non-GAAP adjustments? Really, I want the takeaway for people to get from this is you need to understand what's going into earnings, and especially non-GAAP earnings, because they are just blatantly quite different than what they should be, and a lot of times they are just propping up earnings. And yeah, I guess open it up to you guys.
Well, I love the topic of earnings quality because, we talk about earnings, we talk about price to earnings multiples, but ultimately, the first step is, do we trust the earnings? Is this a real number that actually represents economic value being created? Or is it just an accounting fabrication? And in some cases, it is an accounting fabrication and people still use it. But, there's different ways of looking at earnings quality. One way is to just measure the reported earnings to the cash flow, the operating cash flow, see if there's any major discrepancy there. If cash flow is significantly more than the reported earnings, then that's an indication that the earnings are positive, or the earnings quality is positive. But if cash flow is less or negative, then there may be no earnings quality. That is not something that necessarily works all the time. So in the US, particularly, the biggest difference between GAAP and non-GAAP earnings would be stock-based compensation. And stock-based compensation does not impact operating cash flow in the period that you're actually looking at and analyzing. So then you need to go beyond that and just get into the discussion of, should we actually subtract stock-based compensation, and that's a whole other segment, which we've done in the past as well.
Mm-hmm.
Yeah, it's interesting. There's certain industries where we kind of have to watch the quality of earnings, and one that comes to mind right away is the medical equipment industry, medical services industry, particularly in the U.S., where some of the companies will book earnings, in a current quarter, and they have to still collect that. And some of the collection periods can be a year or two out, and then you either don't end up collecting as much as they originally, like Brett talked about, just being an estimate. Right, you're estimating how much, and you don't collect as much as you originally thought. In some cases, I have seen collecting more, but mostly it's on the lower side, and you really gotta make sure you're trusting either the estimate or just looking at the cash flow, not the earnings that are reported on a business like that. You can get into trouble.